We pay $5,850,000. We put $1.4 million down and get a loan for $4.3 million. Okay? So I think that's a 25% down payment. I don't remember off the top of my head. Because it's a stabilized deal. It's a stabilized asset now. Before, it had a lot to happen to get that value up. Well, now it's stabilized and it's operating, and we can sell that as a yield deal. So somebody will come in here and say, I don't want to mess with the painting and the turning over the residence and improving the units and doing the lease up and doing all the other work it takes. I just want to buy something that's nice and stable and solid and already there, and I don't have to worry about it, and I get cash flow starting day one. Okay? Two different types of investors. One is trying to build value. The other's now saying, okay, I got my value. I just want nice, good cash flow. Well, they pay 5.8, put $1.4 million down, get a loan for $4.3 million. Same numbers we just used. $660,000 in the operating income, minus the $250,000 in expenses that we had, gave us that same $410,000 NOI, right? Okay? Well, your net operating income minus your debt service means you have cash flow of $170 grand. Okay? Now, what was your down payment? There's a hint. It's right up there. Okay. $1,460,000. You put that amount down, and you got a cash flow of $170,000. And so day one, you're looking at a return on investment of 11.6. Now, you're counting on, hey, this is going to keep operating smoothly. We're going to have nice, moderate rent increases. Expenses are going to go up a little bit, but it's just a nice, stable, easy asset. No excitement, no big, hey, big vacancy and paint job and roofs and all of the big, exciting construction stuff. This is just a boring, simple, hey, I bought this property, not doing anything with it, don't need to do anything, and it throws off 11%. Just a different strategy. Somebody who's building their wealth will want to do a lot more value plays. As your wealth increases, then you want to start transitioning more to value plays just to have that cash flow so that you can retire. Right? Okay. Any questions on that? Exciting crowd tonight. Okay. The 7% cap rate and 11.6 cash flow, how do those compare to the market, current market? This is just an example to show you the numbers. Okay, let's say that. The 7% cap rate, it all depends on what kind of property you're looking at. Most properties right now are selling at an under a 6 cap rate. Now, if you have $100,000 and you're getting a 7% return on your investment, right, that'd be $7,000. So if the cap rate goes down, your yield goes down. Okay, so if you go from a 7 to a 6, now you only get $6,000, right? So a lower cap rate will mean a higher price. Okay, so there are cap rates at 5% right now. Okay, there are cap rates, well, yeah, it's going to be hard to find anything at an 8 right now. Pretty much 7 is for a C quality property right now. If you go to a B, it'll be under a 6. If you go to an A quality property, it could be a 4 cap. Okay? There are insurance companies buying brand new properties at a 2% cap rate, which means a very, very high price. Okay? So the 7% cap rate is still a optimistic cap rate to buy at right now, and an 11% return on investment is a very optimistic number right now. Okay, so because cap rates have gone lower, the price has gone up, which means the yield is going to go lower. Follow? Okay. Now the question, does this work? Okay, who believes it works? Who doesn't believe it works? You're in the right place. No wonder you're not impressed. I show you money growing on trees and We're already doing all this. No big deal. Be sure to visit us at darwingerman.com. There you can register for all of our information and see all of the videos. And make sure to like us on Facebook and subscribe to our YouTube channel for more videos.